Your accountant has probably talked to you about the basics, like taking a salary, getting a director's loan, or paying yourself dividends. That's the standard trio. But here's what most people don't realize. Those are just one item, each within three much bigger categories. Choosing to be a businessman or woman is choosing to be challenged. Running a company in Australia isn't for the faint-hearted. You are juggling BAS, PAYG, staff, super, and rules that seems to change overnight. But here's the upside. You are not just earning income, you are building an asset. And unlike employees, you've got control and options. And for a businessman, you have many clean, legal ways and smart ways to extract money from your company that will help you build wealth and lower your tax bill. And that's the difference between working in a business and owning one. Your accountant has probably talked to you about the basics, like taking a salary, getting a director's loan, or paying yourself dividends. That's the standard trio. But here's what most people don't realize. Those are just one item, each within three much bigger categories. You can extract money from your company in the three main ways. The first one is through benefits and salary. The second one is by setting up arrangements with your company. And the third one is through the equity path. So in this video, I will walk you through what's hiding inside each of those categories. These are all the smart and legal strategies that most business owners miss. So now you can be aware of it and start using them to reduce your tax and grow your wealth. So under the first umbrella of extracting via benefits and salary, the rule of thumb is perks only make sense when they don't just shift income from the company to you and trigger more tax in your personal name. So what we are really aiming for are the FBT exempt or otherwise deductible benefits. This is the sweet spot where companies still get a tax deduction and you enjoy the perks. And no one pays extra tax on it. So let's start with the practical ones. The first one is work-related portable devices like phone, laptops, or tablets. They are primarily for work. Then they can be FBT exempt under the work-related item rules. Just make sure they are bought in the company's name. Remember to keep the invoice and jot down a note showing the business use. Second is professional memberships and subscriptions. If the membership would be deductible to you personally because it relates directly to earning your income, then the company can pay for it and pay no FBT under the otherwise deductible rules. Things like CPA, CA membership, license fee, or professional insurance. Just keep a note explain how it ties to your role. Another benefit is training. You can have your company pay for your master degree, courses, or training. Just remember to keep record of course outline and show how it relates to your duty at the company. A very big standout is electric vehicles. If they were first held after 1st July 2022 and under the luxury car threshold for fuel-efficient vehicles, which is around $91,000 for 25-26 financial year, they can be fully FBT exempt. You can package them with a novated lease and salary sacrifice, which will help reducing your personal tax further. Now, for a powerful one most people overlooked, you can rent your home to your company as an office. If you genuinely dedicate part of your home exclusively to the business, the company can pay you commercial rent under a simple agreement. The company claims a deduction for the rent and you declare rental income, but you can offset the rent with electricity bills, internet, insurance. The catch is using part of your home exclusively for business can reduce your main resident exemption for the portion that you use for the business when you eventually sell the property. So remember to also check your council or strata rules, land tax threshold, and insurance policies. Last one, don't forget small benefits like light refreshment, meals, that you provided at premises. These are deductible to the company. This is much better than buying groceries in your personal capacity. Noting that these should only work if you have an office space with a canteen or a kitchen that is available to all of your employees. And of course, the backbone of this is the salaries, apart from the benefits. So this is your salary and super. Pay yourself a commercial rate if you actively work in the business, and add super at 11.5% for 25 financial year. And consider salary sacrificing extra super within your concessional cap. This is up to $30,000 in 2025 and is indexed every year. This contribution only get taxed at 15% in your super fund, which is much lower than your personal marginal rate. Remember to document this properly, especially the salary sacrifice. The takeaway under this section is build your base salary and super, and then layer it with equity exemption benefits like device, membership, or training, and set up a arrangement of home office with your company if this suits your situation. Let's talk about second umbrella. This is extract via loans and company arrangements. Now, let's talk about loans. The area most people accidentally trigger Division 7A. The golden rules is if you take money out of a private company and you are a shareholder or an associate, it can be treated as an unfranked dividend unless you handle it properly. So if you draw money personally, you've got two options. Either you repay it to the company by the lodgement days of the company tax return, or you have to put in a complying loans in place. So you need a formal loan agreement with benchmark interest and minimum repayments. Keep the loans ledger properly and remember to reconcile it regularly. Now, the reverse is much cleaner when you're lending money to your company. If you fund the company activities from your own savings or your trust, the company can pay you commercial interest rate. That interest is deductible to the company and accessible to you. Remember to use a written loan agreement and set a fair market rate. Keep records for the repayment. Next is inter-entity arrangements. So this includes service agreements, IP license, or leasing equipment. So if you own this asset personally, you can deal with the company. You can give the rights to the company for the use of it and earning money from the company. Just make sure the pricing is commercial and documented. The takeaway here is if money flows from the company to you or your trust, assume Division 7A applies. Document everything and treat the arrangement like an arm's length deal. The third umbrella is extract via equity path. So finally, this is a big levers. This is where real wealth extraction happens. So people normally start with franked dividends. They remain the cleanest and most common method. You are effectively pooling profits that have already paid company tax. So franking credits that let you offset the tax you lodge your personal tax return. So plan your timing and make sure the franking account is reconciled before you declare the dividends to make sure you have enough a fully franked dividend. So timing also matter. Deferring a dividend to after 30 June can push you into a lower tax bracket, but always weigh in the cash flow and other repayment obligation, right? And document every decision with a proper board minutes and distribution statements. These are legal documents that you must obtain. Some companies use alphabet shares to pay different dividends to different shareholders. So for example, you give yourself ordinary share and issue A-class shares to your wife, B-class shares to your brothers. That can work, but be careful. The ATO will strike down any attempt to stream franking credits selectively. If you go down this route, make sure you get professional advice first. And then there's share buybacks and capital reductions. These are powerful tools to extract value, especially when ownership is changing or you want to pull out large sums. Part of the payment can be treated as capital rather than dividends, so you don't have to pay tax on the capital part. And a return of capital may trigger CGT instead of dividend tax, so which can be a good benefit because the CGT you may apply the 50% general discount. So make sure your account reflects real contributed equity, not disguised profit. Maintain accounting is very crucial to do this arrangement. If you are winding down, a member's voluntary liquidation can be elegant. Liquidators can distribute capital gain that's sitting in your company as a capital gain directly to you and not a dividend. So normally the extraction of profit out of company can only be a dividend, but liquidator can still take the character of capital gain and give it to you as a capital gain, especially the CGT exemption. So that's a technical move, perfect for retiring a surplus company cleanly. And for the biggest exit is selling your shares. The small business CGT concessions under Division 152 can be life-changing. If you qualify, you can access the 15-year exemption, which means the entire gain are tax-free. Or you can get the 50% active asset reduction, which you can layer 50% general discount on top. And then there's retirement exemption rollover. This one, the tests are very complicated, but it's really worth it. So get a professional advice to make sure you achieve the best outcome. The takeaway for this section is big wins come through plannings. Franked dividend buybacks, capital return, or small business CGTs, where you can legally extract the most money, but they require careful planning. These things have to do in advance. You cannot just do it in the last minute. And to recap, how to choose your mix like a pro. Discuss with your accountant how to start with the basics like salary and superannuation, and then layer it with FBT exemption perks. Then you can add on other arrangements. And remember, make sure every inter-entity deal are commercial and documented. Keep your loans from the company clean. If you draw cash, have a Division 7A plan in place. Then plan your equity strategy, reconcile franking credit before declaring a dividends, and model big events like share buybacks or exit with a CGT in mind. If you find this video is helpful, don't forget to like and subscribe. I'm Hannah, the tax advisor you can trust. Thank you for watching and see you next time.